Welcome. Again, it's great to have you all here today for our sort of bi-weekly sort of business growth discussions. And we're going to be talking about business growth through financial EQ. You think, what is that all about? Well, we've got some incredible people that's going to help us sort of dissect that really. But as you all know, I'm a big one about data and about numbers and ensuring that the numbers really drive the business growth of our companies and activities. So without more to do, I just want to introduce a couple of our guests who's going to help me to just navigate our way through this particular subject. First of all, I want to introduce William Napier-Fleming, and thank you, William, for joining us. I'm sorry about saying your name again, but I should have practiced that. So
it's a bit of a mouthful.
Thank you again for coming on board as well. And also I want to get involved, Micah Wright as well. So involved in that as well. So thank you, Micah, for coming on board. Let me just introduce these two guys. So Will Napier Fleming is Director and Senior Consultant of Kent Finance. Will's been head of finance and the finance director of some of the fast-growing groups in the country, PE-backed casual dining group, Acorn Care and Education, as well as some AIM-listed Care Tech PLC, which I know very well. And this experience combines with over 100 completed transactions valued over 1 billion, gives Will a real deep understanding of how entrepreneurs and investors can leverage the finance function of business to maximum effect. And prior to his career in industry, he studied mathematics at Imperial College in London before qualifying as a chartered accountant in audit at Creston Reeves and served as the manager in corporate finance at Hazelwood. So welcome, Will, to the show. And Micah is a senior associate at BTG Advisory, a law graduate by profession. Micah began his career at KPMG and has now moved to the dark side of accountancy with experience in the restructuring of businesses, especially in the insolvency area. And he's now involved in a range of business advisory and merger and acquisitions for businesses with BTG Advisory. So welcome, Micah, to the show as well.
Thanks for having me.
No, good to have you guys. All right. So again, just to help you with a sort of direction of travel today, really. Very much, obviously, we're going to be having our discussions. Obviously, we've had our introductions. There's some Q&A as well. So just give you an overview. It would be an hour in our discussions. There's an opportunity, as you know, we're live across multiple platforms: Facebook, LinkedIn, YouTube, as well, or should I say, and also Twitter, or X, should I call it, x.com. So we're live across those platforms. Each of those platforms will be sending me, if you are on there, chat information. So please use the chat on each of those platforms. And it'd be lovely to hear from you. We may incorporate questions as part of the discussions or at the end anyway, as we see fit. But please get involved. It's really important. We want to help you and support you in some of the issues that you have in your business around this particular subject. So, yeah, love to have you. So thank you for that. What I want to really do is just set the scene before I get into the discussions with Will and Micah. And really, from my perspective, define what I mean by financial EQ. So you may see on the screen, hopefully, some of the sort of definition from my perspective. But really, in simple terms, I'm a great passionate one of getting business leaders to make better financial decisions and manage their finances effectively. And more importantly, foster that sort of culture of financial well-being with the organization through active listening, risk management, and conflict resolution. Because normally what tends to happen is that, when you tend to have a sort of finance-led activity, there's no real discussion of why the numbers are, what it means, why should you collect the information as necessary. It's done as what any organization would do. And I think if we can help our organizations and our people to really understand the importance of not only collecting that numbers, but what do they mean to profit, waste, what it means to growth, what it means to innovation, then I think that would be really, really important. And hopefully Will and Michael will help us to navigate our way through this element of creating this financial emotional intelligence element or financial EQ within our businesses. So that just gives you a flavor of some of the things that we're talking about, and hopefully we'll go from there as well. So we've got a number of questions to kick it off. I'm sure we will just navigate and go into the trees in different areas as we go along, but that's okay, because it's such a big area, and I'm sure that we're going to be covering quite a lot of things anyway. But because of your backgrounds, guys, you're more or less coming in where people are, how can I put it? It's more reactive elements in the sense that they want information. They're not quite sure how to either present information or even obtain the information in terms of the financial analysis on their business. And obviously, in your case, Mike, at times, you are going in and actually having to take up the pieces of organizations who are not quite sure in terms of, whether they're going to survive or not survive, or about to go bankrupt, but in that sort of insolvency situation. So my first question to both of you, and probably to Will first, is why do organizations ignore the power that financial analysis and modeling can have on business growth?
Well, first off, I think if you're listening to this and you're thinking, I don't know anything about financial modeling or numbers, and you're a senior leader within business, that's not abnormal. I mean, we work with a huge number of entrepreneurs every year. And what I'd normally say is that entrepreneurs are generally really good at what their business does. They're very focused on the sales side of things, or the operational side of things, the quality of the product or the quality of the service that's being provided. But that doesn't necessarily mean that they're an accountant as well. And so for a lot of businesses, because if they've been growing successfully, the entrepreneur has been focused on the bits of finance that matter to them. And they'll have a good idea of how to look forwards based on where the sales are going and that sort of thing. But they won't necessarily have a model sitting behind it. And you can get a business up to a reasonable level of scale without having that kind of support function. The challenge comes when you start to grow very significantly, and you need to either get some form of institutional investment, external investment, or some form of debt. And all of a sudden you realize the level of data hygiene that these people need is way higher than anything you've ever really had before. Equally, and I think this is probably to Mika to comment about, when things start to go sideways and things aren't performing as well as you'd like them to be, that's when you can also see the cracks starting to be exposed, where perhaps previously you've been used to being able to run the business based on what's coming up in the sales pipeline. All of a sudden you need to know a lot more about what's happening with cash flow. And so I think it's almost accidental that businesses can get to a point where they've grown enough without these sorts of support functions and materials. But yeah, it's when they go through very big periods of change that they realise there's a gap. Oh, we can't hear you there, Wayne. Sorry.
Unmute.
That would be good if I unmuted myself, wasn't it? Technology, bless. And but anyway, but ultimately, it's quite funny, in fact, how in relation to organizations, it's how can I put it? It's been insidious. It sort of creeps up on you, the need to have better financial analysis and data systems in place. And I knew one particular company, and this business is 2.5 million. They've got another subsidiary which is a 1.5. And from this guy's perspective, the bank account is his raison d'etre in terms of how well the business is doing.
Yeah, we see that a lot.
It's just madness.
We see that a lot. I think a lot of entrepreneurs will run the business based on the bank account, based on the money that they can see in the bank, and the biggest focus area for them is have I got enough to pay people at the end of the month? What's coming in from my clients? What's coming in from my customers? All those sorts of things. The challenge then becomes when you're starting to look forward and think about tax flows or repaying debt or these sorts of things, or if you, as is often the case with a lot of our clients, if you're investing heavily in new sites or new equipment or doing acquisitions, then those sorts of things are the kind of things that can trip you up.
No, definitely. Definitely so. And Micah, the sort of same question to you in terms of, obviously you're coming in when it's desperate stakes in that respect, and when you talk to the directors, obviously you got to do a director's report at the end of the day. What's the sort of some excuses that you see in terms of that report, in terms of directors not really getting the grips on the numbers? What's the big issues coming through?
I suppose people just aren't really prepared to. I just don't think they don't think it's that important ultimately. So I think stripping it back, lots of people find the whole notion of a financial model to be quite scary. It seems very techy and complicated. You kind of think of the matrix numbers flowing through, like some big dashboards and stuff. And ultimately, I think a financial model is just trying to give you a guide or some view of what the company will be, how the company will be performing in the short term, medium term, hopefully long term as well. William will be quite familiar with the phrase of all models are wrong, but some are useful. And I think that is quite, it kind of takes the mystery and intrigue around what models actually are. And they can be really simple or really, really complicated. So you could, as a restaurant, you'll be looking at maybe a 70% gross margin. That's your aim. But a model might help you understand how you can get there and how to maintain that when you have price rises, as we currently have with the cost of living crisis. So I think lots of people just find it very complicated and quite a daunting process. They think, why on earth would I need it when, as William was already explaining, you've got a good grip over your operational the operational performance, your product's great, you have cash in the bank. So you think that there's no need for me to be going into this amount of detail about this. And I think that's the sort of second point, is that often things come, when it rains, it pours for a lot of businesses. And what we see for a lot of directors is that it's not a slow kind of decline, although that does happen, but often you'd get a massive tax bill that you didn't quite foresee, or your pipeline just completely dries up. And again, you didn't really foresee that. And all of a sudden you do have to be going out to, institutional investors. You need to be going to banks to get some support in that way. And William, again, correctly pointed out that they do have a high standard for data hygiene. And as a result, you need to be presenting management information, financial information that makes sense. You need to be able to do that quickly. And it needs to all reconcile and be enough for them to be able to lend or invest on that basis. And I often sort of think of it as I don't think any of us probably, William maybe has done big wave surfing, but when you do big wave surfing and you get hit by a big wave, you can get thrown 50 feet under the water. And a lot of people don't actually know which way is up. And I think what happens with a lot of businesses is that they get hit by these big waves and they start thrashing about and think, oh, what should we do? We should amend the product. We should raise the prices. And you start making decisions which actually don't have a firm basis. So I think that's just highlighting the importance of sort of financial analysis, financial modeling, that you need to start from that and say, where are we? Let's have a really good view, holistic view of the business, how it's performing, the challenges in which we're facing, and let's use this as a guide to make good decisions instead of ultimately swimming the wrong way when you don't actually know what's north.
And that's so true, and I think really ultimately, when I talk to organizations, it's incredible how they think that the rainy day is never going to hit them. And sometimes they're on been on a growth journey. They've got a new product. Everything's being hunky dory. They really make some entrance in the marketplace. And to be fair, probably not you, Micah, but certainly William will be familiar with the sort of banking crisis of the 2008, 2009. We've had some incredible growth over the last 20 years, and people haven't really seen and felt a recession apart from obviously the pandemic. So for a lot of people, the trajectory has always been going up. There's never that end of the turbulence in the marketplace. So what I'm trying to propose is that organizations really try and, while things are great, get your act together, get the models together. It's really lovely that you are saying, Micah, that they don't have to be complex. And I'm sure William can probably share that in our later question as well. They don't have to be complex, but sufficient enough to help you to navigate and understand some of those potential pressures and navigate those big waves and what ifs that are coming down the track as well. Before we talk about the sort of solution elements of that, and I will want to navigate our way through that conversation. First of all, I just want to just get some examples. I want people. I won't put the fear on people, but it's important to do so because sometimes, you can walk around thinking it's never going to happen to me.
Yeah.
And I think really, I want to really ensure that people understand that, yeah, the best of companies, it can happen to you. It doesn't matter how small or big you are, it can happen. So I just want to give some examples of companies that either have been struggling or failed or whatever, and how, using the sort of financial analyst and modeling and its EQ elements in terms of getting that culture back into your organization has made a big difference in turnaround. Don't know. You want to start, Michael, on your side?
Yeah,
You're
sure.
the insolvency king.
No, I mean, I feel like I'm pulling us down into talking about bankruptcy when it's called business growth. So I apologize for that. I think they do kind of go hand in hand.
Absolutely.
COVID is the best example, I think, for people that would have too much of a rosy view of the prospects for their business. Lots of people, I think every single business was affected most negatively through COVID and the subsequent lockdowns that occurred. And you had businesses that are doing really, really well and could have never foreseen this kind of black swan tail event occurring. And a lot of it was like you could do as much modeling as you could, and you would never be able to capture the exact impact it would have on your business. But I think it just, again, underlines the point that anything can happen. Lots of different things can happen. If you have an overdraft, if you have debt with a bank, we have lots of examples of that where we have companies that are doing amazingly well and they breach one covenant, not even anything major, or something's not clear and they're not able to provide their financial management accounts on time, or there's some misstatement or error, and all of a sudden the bank are on their back, and you have the possibility that the bank can take enforcement action against you, despite having a context of you performing really well and things looking good for the medium long term. So those are two examples that I see quite a lot, and where people are often really surprised, and all of a sudden they're scrambling around trying to get good information out when they didn't have that before because they never thought they needed it.
Sure. William, you want to just add to narrative?
Yeah, so I mean, we often talk about our clients in two groups when the referrals come through to us. We see people who are preppers and people who are panickers. So preppers are businesses where they've been able to think forward. They've had some good advice. They're generally sort of getting their act together before trying to do something complicated. Whether that's a debt restructuring exercise because they're rebanking their business, or whether they're going to do an acquisition or an exit. And then you have people who are the panickers, who are the ones that turn up late. And I suppose the panickers are probably the ones that I would naturally jump to, because, I mean, as Mika highlighted, you can have lots of stuff that happens in the macro environment you don't have much control over. And a model will help you to understand what's happening around you and what impact that's going to have on your business and make good choices. But the stuff you do have control of is stuff that, if you had a good model in place, you'd be able to make happen better. And so the scenario we see quite a lot is where someone's taking a business to exit. And so they're looking to do an MBO or something like that. A private equity house maybe trying to buy them, a corporate finance broker's working with them and presenting their business to the market. But the quality of the data they've got is poor. And their ability to explain, how their business generates profit or growth is inadequate. They've got some great ideas. They might have a fantastic product and a really, really interesting and exciting business, a wonderful brand. But fundamentally, the numbers aren't strong enough for the corporate finance broker to be able to explain that to the market. And this is where you see, your universe of potential buyers contract extremely quickly. So, when you go out to market with a corporate finance broker, they'll usually approach quite a lot of different investors. You might talk to people in the trade that you're in. You might talk to potentially to private equity or venture capital. And so they'll get a pool of people interested. But what happens over time is more data is released to this pool. And if the quality of the data is good, and if it ties back to what's happening in real life and it doesn't create any surprises along the way, what you get is these buyers get more excited about it. They start to compete and you have competitive tension. And that's how a corporate finance broker will generate fantastic value. On the other side of the coin, if the data is weak, if the answers aren't good enough, then that buyer pool starts to reduce, because a lot of the buyers won't feel comfortable buying a business that's got challenges in it. And they see the data answers, the poor answers, as indications of challenges. And so what you end up with is maybe only one or two buyers, and they're the ones who hang around hoping for a deal to go a bit more challengingly and then get something at a bargain. And then all of a sudden, instead of having competitive tension, you're in a race to the bottom. And this is often, one of the sources that we get for referrals is corporate finance brokers calling us up and saying, look, we've got this business, we can't get any good numbers out of it. Please, can you come and help us out in a hurry? Of course, from our perspective, you've only got a few weeks to play with. You can definitely create a lot of value. You can turn the project around, but ultimately, a lot of the damage has already been done. And really, it's about getting the deal over the line then, rather than actually maximizing value and creating value. And so we'd always try and encourage our clients to be preppers rather than panickers. But it's an education piece. That's why these sorts of conversations are so important, Wayne. And I think it's fantastic that you're bringing this to people to be able to talk about and think about.
And just to have a sort of slight tangent, let's go have a little bit of tangent here on this. What sort of data? What sort of basic data? And I think you mentioned that, Mike, in terms of that doesn't be complex. What sort of basic data would you be looking for to at least give you some confidence that the business is managed and financially run effectively? What would you be looking for typically when you go into those organizations which are falling over? What are the things that are missing that you thought comes if they act together that it would, this would probably be not as a basket case as what we're finding it to be?
I think contemporaneous data, so having things that are data that's fairly recent and consistent is better than having 2021 accounts, which are absolutely wonderful, filled with lots of great information. But then there's a massive gap between that and what you have now, and what you have now isn't potentially that great. I think that's quite important. And I think there's a journey, I suppose. I mean, the first is to have data to use. Then you have data that is consistently available, because to be able to make a comparative analysis is really important for people who are looking to invest. I think William was talking about lots of exit opportunities, and I think that's something that I get to see a fair bit. And we do a lot of accelerated M&A processes, and that sort of having data which is recent is really, really important, because ultimately any savvy prospective purchaser is going to use any excuse to chip away at that price. So if there's some opaque parts of your financial information or company information, if you can't explain things away, that is a great opportunity for someone to chip and say, well, we're not prepared to take a risk on something we don't have full clarity on, so we'll take a discount on that. And so, yeah, I'd say having data that is readily available and reflects a pretty current position is a really, really good start.
And I want to get into detail, because I think and I appreciate every market and every sector is going to be different. But is there sort of top 5? Well, let me put it another way. If you want to create a dashboard, which would help you to really get a sense of how the business is doing at any one time, what would those sort of key elements and metrics would be? William, you may want to pick that up, and then obviously I'll come back to Micah in terms of his thoughts from the restructuring perspective and the M&A perspective.
Well, as you know, Wayne, I'm a complete data nerd, so
hallelujah.
I'm the kind of guy that there's never too much data for me. Unfortunately, I'm that kind of person. I like to be able to have an awful lot of information at my fingertips. However, I think if you're talking about growth businesses and you're thinking about, perhaps talking to a lender or an investor about the business and trying to get their attention, what are they going to be interested in? Well, they're going to be interested in your cash flow. They're going to want to understand, how your trade is going to turn into cash, because that gives you a really good indication of the level of risk within a business over time. And so having a really strong handle on cash flow is very important. A lot of entrepreneurs will think about turnover as their key measure. Well, banks and investors are probably more interested in cash security. So that's key. Connected to that, then, it is the turnover. It depends what kind of sector you're in. We do a lot of work in healthcare, for instance, where you've got people in care homes. We also do a lot of work in hospitality, and they're completely different. So care home example, you've got contracts. They're ongoing, but you want to understand what's changing there. Are there people leaving? Are there people joining? What's happening with the pipeline? If you're talking about hospitality or leisure, well, you need to understand your like-for-likes and your historic trends. So what's driving growth? Have you got problems in a particular site? Have you got challenges there? Or is the site doing really well because you carried out a refurbishment in recent years? So I'd probably pick on those two things, cash flow and your turnover as key. Outside of that, it's the whole P&L, really. I mean, it's interesting when you listen to people going on things like Dragon's Den and places like that. One of the things they always get pulled up on is not knowing their numbers.
Yeah.
And taking those two industries, I often use hospitality as an example when I'm going into care businesses, because if you go into most restaurants and ask the GM, how they're getting on this week, they'll be able to tell you how many covers they've had this week, probably. They'll be able to tell you a fairly good idea of how that compares to the previous week, how it compares to their budget, how the split is between lunch and dinner. They're quite number centric. Whereas in healthcare, people don't tend to be number centric. If you ask them, for detailed number questions, they'll usually give you a slightly blank look and then ask you if you want a cup of tea and a biscuit, and you go and have a nice chat, because that's the way they're motivated. And so it does depend on the sector very much.
Of course.
Using finance to help that is really critical.
What, any other thoughts, Micah? And I was going to.
I know, I agree. I mean, it obviously does depend on the sector a huge amount. I think there's this silly phrase of revenue is vanity, profit sanity, and cash is king. And
yep.
I think a lot of people get a little bit caught up, as William was saying, about, well, we're doing these numbers. This is our turnover for the last year. That's great. But you think, well, what does that really mean? And then the next step, profit, which is really helpful sort of at its base. But again, there's lots of accounting wizardry and trickery that you can do to massage and help those figures. So the best sort of starting point for anyone looking at anything, and if you're a business, if you're trying to pitch yourself, is your cash flow and your ability to either, if you're looking to invite further debt into your business through lending, then you need to show that you can actually service that debt. If you obviously want to attract further investment through equity investment, then you also need to show how you can produce and pay dividends, or how you can reinvest cash into the business so that at some point in the future you're able to pay some really great dividends that also accounts for the fact that you hadn't been paying dividends in the 2 years prior. So I think, the cash is really important. So be able to have a really good view of where you are in terms of your cash, where you're going to be in terms of your cash, what even things like margins. So is a really, really good so understanding what the margins are on different products that you have is really important. But I think for the other stuff, it really, really does depend on the sector. I mean, people obviously love throwing things like EBITDA around, and that can be helpful. But ultimately, we're trying to get down to basics and strip out as much as we can in terms of sort of technical adjustments and things like that, and understand the raw figures of how is this business at its core performing.
That's a nice segue into my view, and I mean, that's the cash element is so important, and I, when I go into organizations, I really try and how can I put it, get this sort of notion of what are the profit levers in your business. In other words, what are the things that are going to change the dial of your profit negatively or positively? And so obviously you've got the classical, you know, P&L and cash flow models that are really important. But getting down to the grips of the business, I think you mentioned a little bit, Micah, as well, in relation to restaurants and margins. You know, what are we're talking about? Are we talking about, you know, portion control? Are we talking about food prices? Are we talking about energy costs? So what are those things? What are those detailed elements of your business which, if they change, and they have changed, for example, energy costs have gone rightly through the roof. Raw material costs are, you know, if you're in construction, have gone up 20-30%. That's why HS2 is a nightmare to a lot of the government, because the raw material costs and the salary costs have trebled in terms of 30-40%, you know, over what was predicted 10 years ago. So what are those profit elements in organizations that people should be really looking at that change that dial? I call it profit levers. But you know, what are those things that change the dial effectively? William, you may want to say something about that.
Well, yeah, I was just going to say, I mean, this is where, you know, your approach to modelling is quite important, because we work across lots of different sectors, and the reality is, you know, I'm an accountant. Yeah, I don't do actually delivering healthcare. I don't do actually running a restaurant hands-on. I'm here to do the numbers. But if your model is just in accounting terms, it's completely irrelevant to the business, frankly.
100%.
And so, you know, when we're modeling, we start with basic components that are the way the ops people think. So however the operational side of the business is run, if it produces widgets, we get under the skin of what drives demand for widgets. We get under the skin of, you know, what are the components of widgets? How does that cost work? What's fluctuating there? Because if the model is not operating in the way the business is run, then it will be irrelevant. It won't generate the right numbers. And more importantly, Micah said this at the start, you know, models are generally wrong, you know, but ultimately they're useful. Well, yeah, as soon as you cut a model, the numbers will diverge from that, because the reality is always different from what you plan. It's not about the fact that it's diverged, it's about why. Yeah. And you can't understand why if you don't have it built in the core components of how a business is run.
No, 100%. Michael, do you want to add any more?
No, I agree with that completely. That I think there's the other thing of having, I think William pointed out, having these models, and there's some sort of rigidity to, for example, if you said, okay, we want a gross margin of 70%, we will never go below that. Neither would we seek to go above it. And so everything, I mean, it's good discipline, especially if you're looking to limit cost and outlay. Then you do want to make sure that you're hitting certain figures, and you're not just, especially in procurement, just agreeing everything and anything. But I think that you can fluctuate, and you can go between going below that and above that, depending on what you're seeking to do. So an example of that is if you're, for example, trying to create scale, or if you're trying to increase your market share, you might think, well, we need to lower our prices and therefore lower our margin, with the expectation that later on down the line we'll be able to increase it because we've got a higher market share, or we've sort of given our product sufficient exposure that people know about it, and people have already, so there's been a good uptake of it, and we can leverage that going forward. So I think it's looking to, in any sort of analysis and assessment and modeling, you want to have a core assumption We also need to be able to test, well, what if we do this? What if we do that? What's the elasticity of this product? As in, is the demand always going to stay the same? Does it really decrease that much as we put the price up? There's I guess it can be quite simple, in some ways quite complicated, because you can never really know. But I think just having trials and tests, seeing what the market's view of your product is, and the price, and what it actually values of your product. Is it just because it's cheap, or is it just because it's high quality, or is it just because the customer service is really, really good? What are the things that people actually value about your product that make the difference between you and your competitors?
And that's such a great point. I mean, people, like I said, we can lose ourselves in this whole element of data that is, it's like a more internal, focus, navel gazing, really. But again, the bottom line is that how does it apply to the market? How does it apply to customers? Because ultimately, as you rightly pointed out, Micah, you can reduce your costs, reduce your prices in the marketplace. It doesn't necessarily translate to mean that you're going to get market share anyway. Because hey ho, would you believe it? Your competitor reduces the prices accordingly as well. And so you got to find other ways than actually still preserving that profitability and gross margin on your activities as well.
It should come as no surprise, but I love a bit of navel gazing on a spreadsheet. I think it's one of the most fun things to do with a business. I mean, this is part of it. Is that, I mean, Micah's right. The model gives you the chance to experiment, right? This is the thing. It's not just about coming up with some numbers to make a banker happy or to get an investor to buy into your business. When these things are working really well, people are using them all the time. It's not just the accountants. You'll find the CEO actually uses the model quite heavily. I've often felt, the best businesses that we've worked with, where we've put models in, are where it's not just the finance people that get involved in them at all. It's the ops guys get involved as well. And it's like a sandbox. You experiment, you try things out. You see what's going to happen in real life. And that's where, and I think, Wayne, this is where in your projects, this probably plays in the most, is that you're able to then prioritize and think about strategy and think about, well, what happens if I do this one first rather than that one? Or what happens if they both happen at the same time?
100%.
It's all of this, isn't it? It's that ability to play with the numbers and see where it's all going. So I love a bit of navel gazing on a spreadsheet. It's one of my favourite occupations.
Sorry, Micah, carry on.
I was just saying, it's actually really exciting. I like the fact that we've kind of gone from that thing of modelling. It seems like very sort of accountancy based, quite boring, just insert some numbers into a spreadsheet and it kicks out an outcome, and that's what we go with. To actually, no, it's really, really exciting. And when you have all the numbers in the spreadsheet, that's the kind of maybe the boring part about it. But as soon as you have that there, you can fiddle around with things and see what you can do and see what's actually possible. And I think a lot of people will be surprised actually about what their business can do and the different strategies available to their business just through looking at the model and seeing, oh well, yeah, we actually could do that if we really wanted to. I didn't even thought that was quite possible. And that's the way in which you can get a comparative advantage because I don't think everyone is looking at this stuff, and not everyone is looking at ways in which they can be sort of unique and have a unique approach to the market.
We tend to find with the businesses that we're working with that when you put a model in, the business grows quicker. And I don't think that's because our maths is really good. I think it's because of two things. I think because businesses that are preppers generally, if they're investing in stuff like the models that we do, they're generally investing in other good things as well. They're putting good systems in. They're getting the teams to think about this stuff. But the other point is that they make better decisions quicker.
There you go.
So you do more. You act with more confidence. You're able to see, okay, well, yeah, it's going to be a bit painful for a couple of months, but actually the other side looks really good. And if it doesn't work out how I thought it was going to do, then I've got plan B, C, D. And so you act rather than holding back because of fear. So, I mean, I'm very much an upside person with these sorts of things. And I think that's where you see real acceleration. It isn't just the model. The model's part of everything. It's connected to everything. But it enables the senior leadership team to sort of take it forwards and drive it forwards. And that's where it really adds value.
I mean, that strategy piece is super important. I mean, you sort of couched it in different ways, but that's what the bottom line is. You know, the modeling provides that strategic piece to be able to say, you know, okay, are we going to get to where we want to go? And have we got the basically means and wherefore to actually get to where we want to go? You know, via the what if scenarios that we can generate. And as you say, William, you get to information a lot quicker because the numbers do not lie. Mm-hmm. They may fudge things in a way, but in essence, they tell you a path.
Well, they give you a chance. It gives you a chance to try it out. This
there
is
you
the
go.
thing.
There you go.
You know, Michael was talking earlier on about covenants, and so you know this doesn't apply to every business, right? But the vast majority of our clients that are private equity backed or venture capital backed will have some fairly heavy duty debt facilities in with banks to help them grow. They're there to help them grow. They can draw down, they can spend capex, all these sorts of things. The challenge is, you know, you're then measured really robustly every quarter. And these covenants, you know, they're lines you shouldn't cross because you get into trouble with the banks if you go over. I mean, you can negotiate, you can do things, but ultimately you want to play within the box that you're given, you know, to make it work. And so a lot of the time, our strategic dialogue with clients from a financial perspective is around, okay, well, what happens, what scenarios work where you're actually navigating within those guidelines and staying comfortably in there, and how much headroom have you got? How far can things go wrong before you start to trip up, and what would you do if you do start tripping up? So, and I mean, my experience of running these businesses prior to setting up my own one is I couldn't live without this kind of stuff. You know, as an accountant, without having that kind of visibility, I'd be up at night worrying about it, thinking what's going to happen when, you know, Dave buys that property we're looking at. It's all going to go horribly wrong. So,
but the thing about it is that, you know, this is real time. And I think this is one thing I want to impress on people. This is about creating real-time information that allows you to navigate and grow and assess your business in that respect. And you know, because if it's left to the accountant, you know, to provide your set of accounts at year end, you're too late. You're dead.
Yeah.
People don't appreciate that, you know, you create a set of accounts, you still got another year to take it in account, because talking about the previous year.
Yeah.
But really, if you haven't got a set of an analysis and models which allows you to understand today, am I heading the right direction rather than the train wreck, then, you know, it's going to be really, really difficult going forward.
I'm sure Mike sees this all the time. We see it fairly frequently. You'll go to people and say, well, have you got a model? They'll say, oh yeah, we've got a model. We've got a model. It's it's great. So, you know, the corporate finance guys, nothing against corporate finance guys, the corporate finance guys did it for us for the deal we did 18 months ago. Like, so it's 18 months old. Yeah. Have you updated it? Well, we can't. It's too complicated. We've been trying to make the numbers work for a long time. And I think that's the thing here, Wayne, is that, you know, a model, a lot of models are built to do a particular job, right? They'll be there to help get a debt facility or to drive a particular acquisition. But really, it needs to be something that's living and breathing within the business. It needs to be something that's kept up to date every month. The management accounts get done, the model gets updated, the CFO or FD has got a copy of it on his desktop, and every time someone asks him a question, he's having to fiddle around and play with it to answer, you know, to get to an answer. That's your ideal situation. You know, that's when it's going to add the most value because it's live. It's a live.
Yeah. Perfect. I'm conscious of our time as well. As always, we could be here for days. But I really want to address the EQ part of this financial modeling aspects as well, because, you know, what I'm trying to push over to business leaders that, you know, don't think that, you know, we should delegate it out to somebody else. Let me be clear. I don't expect you to understand how it's derived, but I need you to understand the impact of the number that you get in front of you, whether that number is a number that's okay, fine, or is it a number where I have to wear some brown trousers tomorrow because it's going to be hitting the fan in a big way. So ultimately, the bottom line is, you know, trying to get your head around understanding those profit levers, those key indicators of the business, which allows you going forward. So my final question is to you both is, probably start with Michael first as well. How as a business leader can you start to build a financial EQ structure and culture in your organization? Because it's not about just you understanding it. It's about how you can communicate that throughout the organization so people can understand that this stuff matters. This is not something, I just need to get it for a monthly reporting. It really does matter. Micah, do you want to just kick off on that?
Yeah, I think so. Having obviously a clear vision is really important, but I think lots of people have a vision of what they want their company to do. So they might say, for example, we want to grow to 100 people in 5 years. How are they going to actually get there? And I think having the metrics alongside that to sort of actually give a really good illustration of what is happening is really important. So you might say we were trying to get to X, and this is what we're measuring because this is what we believe will enable us to achieve X.
Yeah.
So I think that's a really, really important bit as well. Obviously, there's, I suppose, there's different ways in which you can arrive at the same conclusion. So sometimes, again, being very rigid on certain things may not be advisable, although in other circumstances, you should want to be trying to achieve that under all possible circumstances. So it's understanding what your business needs and what how your business operates and how it functions and what it does ultimately. And that's up to the business leader and the CEO to do. I think the second point is delegation as well. So a good financial director isn't just providing information to a CEO for them to interpret, but this already should be analyzed and assessed. We should be trying to cut out noise so that we can provide already sort of draft workings and draft thoughts about what should be happening. And that should flow all the way down through an organization. So the FD should also be delegating the same thing to others, that they're not, again, as you're saying, producing these reports.
Yeah.
And it's like, here you go, make sense of this. But I've already tried to make sense of this, and I've maybe prioritized looking more into this bit because we know that's a priority for us as a business or an organization. What do you think about this? What do you think about, maybe changing this or putting some more thought into this area or this product? And so you're starting to get this like waterfall of sort of delegation in terms of making strategic decisions.
I like that. Yeah.
And ultimately you get to the top and the CEO and a lot of decisions already been made, and they can just make a final decision or an easier decision to hopefully benefit the business.
No, that's very good. William?
Okay, keep it simple. I think first thing, recognize your skill gap.
Yeah, I like that. Yeah.
No one's asking anyone to turn into an accountant overnight. Some of us were just born this way. It's okay. If you're good at this, great. If you're not, you do need to get help with it. The second layer then for me is you need to have at least a budget for the current year, and ideally a model, which is then giving you a business plan. You need to produce decent management accounts, and you need to sit down as a senior leadership team and look at those together once a month and talk about them, talk about the numbers, because bringing the numbers into dialogue is how data starts to permeate into the business. That's how you start to get people talking about this stuff and managing based on it. And then, think about accountability. Think about who owns bits of the budget and how are they going to, understand whether they've delivered to budget or not to budget. And when they haven't delivered to budget, how are you going to have a chat about that? Once you've got those things moving, you can move on to the next layer, which is the really fun bit, which is then bringing your senior leadership team together and talking about strategy with the numbers there.
Yeah.
Because then you can start to say, okay, where are we going to go? What's the universe of opportunities in front of us? What are the different scenarios that we can go after? How are we going to create growth? What's that going to mean for you, Dave? What's that going to mean for you, Sally? How are we going to take this business forwards? And through that, form some really good common goals, which have got numbers at their core, but ultimately will be driven by the operational side.
Yeah.
That would be me.
That's interesting. Sorry, Micah.
Oh no, it's a really good point. It kind of reminded you of that sort of like SMART acronym, isn't it? Sort of specific, measurable, achievable, realistic, and timely. That you can't just throw numbers out there or things that you would like to achieve, but they actually need to make sense. They need to be achievable. You need to be doing it in a certain time frame.
Yeah.
So it's not a wish list. It's genuinely something that you think you can do, and you need to be able to, at certain points in that process, be able to understand, are you actually able to achieve it?
And it's good. And I think earlier, probably not that last statement, probably the statement before, you talked about vision, Micah. And I was going to give an example of a turnaround situation from my perspective. And I was asked by a couple of VCs to sort out this particular software business, which was failing. And so, you come in there, and obviously, you take time just to have a look at the business in different ways and understand some of the key things that need to drive growth. But one thing that I was quite, which was really important to do from my perspective, having done this sort of thing before, was really to set a clear vision for the team, and the vision really encapsulated a picture which allowed them to buy into their own role. So I created this, what I call pillar analogy. So there's 3 pillars. This pillar is around profit. This one's about operational effectiveness, and this one's about people, and in fact was about customer excellence as well. And then within those each pillars, then obviously we defined what that profit was and how we're going to achieve that. And clearly in this case, it was about software implementation and invoicing, which was obviously driving cash flow. And then obviously productivity in terms of getting this job done quickly, right first time, no reworks, that sort of stuff. So again, another metric, which is obviously has a financial element, but people can understand, okay, we get the job done quickly. We don't have to understand the numbers. We've done it 2 weeks quickly. It's going to generate a nice number. And then the other one, in terms of customer excellence and satisfaction, because obviously, clearly, if the customers are happy, they're not going to pay. So again, that drives cash flow. And therefore, you know that if they get the invoice, there's no queries, bang, money's going to be in the bank. So ultimately, again, using that picture and analogy to allow everybody to buy into the financial model that we had for the business was super important. So we created a model, but the picture encapsulated that model and allowed it to be driven through the organization. And I think really for all businesses, I think as well, just make sure you be clear about the vision, what you're trying to do for the business, and then ensure that your team, has that model around it, which allows you to, capture that information on a real-time basis to ensure that you meet the needs. So every month we looked at those pillars, the 3 pillars, and say, okay, how are we doing on those metrics? Are we getting to where we want to go, etc.? And I think that sort of narrative is super important.
Fantastic.
Cool. All right, so we put the world to rights then, eh?
On a spreadsheet.
So that comes quite nicely in terms of any final thoughts that you have before we just wrap up as well. And so I'll leave a few minutes for you guys just to give us any final thoughts in relation to the whole element of financial EQ as well. And I'll just sort of wrap up and finish. Mike, you want to pick up the final thoughts?
To be honest, I've learned a lot in the last hour. Thanks, both. I think William was just talking about being preppers rather than reactors, and I think that just really captures exactly what people need to be doing. It's just so important to be able to be ahead of the game. And also, I think for people's health and their sleep, I think it probably works out quite well as well. So self-perpetuating, you get good sleep, you make good decisions. So I think all of those things will put you on a sure footing for the future.
Cool. William?
I couldn't agree more. You're absolutely right, Micah. I think having this kind of level of control and visibility just helps you make better decisions. And I think that thing I said in the last answer about skill gap is really important. You need to recognise this isn't something that just anyone can do. Good accountants will naturally default to this kind of stuff, but ultimately, a business needs visibility, it needs control, it needs the ability to plan and measure itself. and so investing in it, prepping, gives you the best possible opportunity to create a really stellar outcome. So yeah, it's a good thing to do.
Great. From my perspective, clear vision, guys, in terms of understanding, how the model that you're trying to do, where you're trying to achieve is and create the financial model around that vision. And then the EQ part of that is how do you communicate that to your organization to ensure that they buy in to those numbers and create pictures, create frameworks, whether it's another organization called it a OTIF, on time in full, which was like a delivery, a metric to the organization. They capture that on a regular basis and put some numbers around that. Again, all those things will feed back into the P&L and cash flow models. So again, create frameworks where you can have on a daily basis those metrics which have you that create that dashboard, so that you're not just relying on your accountant visit once a year to manage your business finances going forward. So that's my take on that. Anyway, well, thank you again, William and Micah. I really do appreciate your input. So much has gone on. Again, we could be talking for another hour as well, at least anyway. But I do appreciate you guys doing that. Again, just some sort of admin as well. Please reach out if you want to have a chat a little bit more. Then have a talk again to all of us. You can get Micah on LinkedIn, and Will, his email address is there as well. Again, you see some of this information is in my book, which is then on Amazon, on book, Kindle, and Audible. So if you want to hear my sultry tones, then please pick up the Audible book, and there's a big section there on finance and the importance of finance for business growth as well in my book, The 10 Commandments of Business Growth as well. If you want to hear more of what we got coming up, then please subscribe on each of the platforms as well, so you get some information coming through. But again, say thank you again, gentlemen. Really do appreciate your expertise and knowledge and insights. And we wish you all a great afternoon. And please be financially EQ'd. See you soon.
Thank you.